Okay, so you think Wendy's makes its money selling burgers. You walk in, you order a Baconator, you hand over $12, and somewhere in a corporate office in Dublin, Ohio, a number goes up. Simple, clean, obvious, except that's not really how it works. Here's the question nobody asks when they're standing in line. When you buy that burger, who actually keeps the money? The restaurant you're standing in is almost certainly owned by someone who is not Wendy's. It's a franchisee, an independent business operator who licensed the name, the menu, the uniforms, and the square patties. That operator paid for the building, hired the employees, sourced the beef, and keeps the electricity running. They bear the full cost of everything you can see, smell, and touch inside that restaurant. Wendy's corporate? They may not own a single thing in that building. They just get a cut of everything you spend. That's not a restaurant business. That's a royalty business wearing a restaurant's uniform. Think of it this way. Wendy's corporate is less like a chain of restaurants and more like a landlord who also owns the brand, the supply chain, the training program, the advertising budget, and the right to tell every operator exactly how to cook a burger, while collecting a percentage of every single sale, every single day, whether the location makes money or not. And once you understand that, one of the most confusing things about Wendy's suddenly makes perfect sense. How can a company post declining restaurant sales and still generate hundreds of millions of dollars in operating cash flow in the same year? That's the question this entire video answers. Let's build the machine piece by piece. Because this is where it gets interesting. When an independent operator joins the Wendy's system, they don't just buy a sign and a recipe. They enter a financial framework that extracts value from their restaurant in 4 separate and simultaneous ways. First, the royalty. Every time a customer buys anything, a burger, a Frosty, a side of fries, Wendy's collects a percentage of that gross sale, not the profit, the top line. Wendy's royalty rates typically range between 4 and 6% of gross franchise sales depending on the market and the agreement. That means the restaurant doesn't need to be profitable for Wendy's to get paid. It just needs to be open and selling. Second, the advertising contribution. On top of the royalty, franchisee contributes roughly 4% of gross sales into a corporate-managed advertising fund. Wendy's controls how that money is spent. National campaigns, digital promotions, app discounts, all funded by the operators, all managed by corporate third, franchise fees. When an operator signs their initial agreement, renews it after 20 years, or transfers ownership to another franchisee, Wendy's collects non-refundable fees. These aren't enormous numbers individually, but across thousands of locations, they create a steady stream of cash that requires almost no ongoing work to collect. Fourth, rental income. In cases where Wendy's holds the underlying real estate, the land or the building, corporate charges the franchisee rent on top of everything else. This is the real estate arbitrage layer of the business, and it turns Wendy's into something that looks, in certain financial circles, less like a fast food brand and more like a commercial property trust that happens to sell square hamburgers. Now compare that to how a normal restaurant makes money. A normal restaurant sells food, subtracts food costs, subtracts labor, subtracts rent, subtracts utilities, and hopes something is left over at the end. Its entire financial fate rides on the gap between revenue and costs. A gap that can disappear in a single bad month. Wendy's corporate doesn't live in that world. Its revenue equation looks like this. Take total system-wide sales across thousands of locations, multiply by the royalty rate, add franchise fees, add rental income, add advertising fund revenue. The costs on the other side, corporate overhead, marketing, technology, are manageable and predictable. Imagine a single franchise location doing $2 million in annual sales. The franchisee worries about every beef patty and every utility bill. Wendy's simply needs the restaurant to keep selling. At a 5% royalty, that one location generates $100,000 for corporate, before fees, before rent, before advertising contributions. Now multiply that across nearly 7,000 restaurants. That's the machine. Here's the part that surprises most people. Wendy's barely owns any of its own restaurants. As of fiscal year 2025, Wendy's operated 7,397 locations worldwide. Of those, only 434 were company-operated. That means roughly 94% of the entire global system is run by independent franchisees. In the United States specifically, only 423 out of 5,969 restaurants were owned by corporate. The other 5,546 belonged to someone else. This wasn't an accident. It was a deliberate structural decision. When Wendy's owns a restaurant, it captures 100% of the sales, but it also inherits 100% of the costs. Every wage increase, every spike in beef prices, every broken fryer, every slow Tuesday is Wendy's problem. The capital required to open, staff, and maintain a single quick service location is enormous. Multiply that by thousands, and corporate is suddenly in the business of managing a massive capital-intensive operating company with thin margins and enormous exposure to input cost volatility. When a franchisee owns the restaurant instead, the franchisee brings the capital, absorbs the operating risk, and manages the day-to-day complexity. Corporate steps back, collects its royalties and fees, and deploys its resources toward brand strategy, technology, and marketing, the areas that generate leverage across the entire system rather than costs that only apply to individual locations. This is what financial analysts mean when they call a business model asset light. The company scales its revenue without proportionally scaling its balance sheet. But here's where the model has a hidden complication, and it's one that Wall Street doesn't always acknowledge quickly enough. Wendy's corporate is not just a passive royalty collector. It is entirely dependent on the economic health of its franchise partners. If franchisee profitability collapses, the entire system degrades in slow motion. Operators stop opening new locations, they delay the mandatory renovations that keep the brand looking fresh, they fall behind on royalty payments, they close underperforming stores. And eventually, the royalty stream that makes corporate look so efficient starts to shrink. Wendy's doesn't need every restaurant to be spectacular, but it does need enough restaurants to remain economically healthy for the entire franchise system to keep functioning. Let's look at Wendy's actual revenue breakdown, because the numbers reveal something important about where the real business lives. In fiscal year 2025, Wendy's reported total revenues of approximately $2.18 billion. Break that down by category and you see 4 distinct income streams running simultaneously. Sales from company-operated restaurants came in at roughly $905 million. The direct restaurant business, the one most people imagine when they think of Wendy's. That number declined about 2.6% from the prior year, reflecting weaker traffic and some store closures. Franchise royalties and fees contributed around $512 million. This is the core of the asset-light model. Money earned from thousands of restaurants Wendy's doesn't operate. That number fell about 5% year over year, a sign that system-wide sales were under real pressure. Franchise rental income added $230 million, steady, flat, reliable. Real estate doesn't care whether beef prices spiked last quarter. Advertising fund revenue brought in nearly $397 million. The mandatory contributions from franchisees that flow through corporate before being deployed on national marketing. Here's the insight that makes all of this worth understanding. The same customer purchase is generating value at multiple levels simultaneously. A customer buys a meal. The franchisee collects the revenue and pays the costs. Wendy's corporate receives the royalty, the advertising contribution, and potentially the rent, all from a single transaction at a restaurant it doesn't own or operate. Commodore Restaurant, franchisee, Wendy's corporate. Each layer extracts value from the same burger, the biggie bag, $5. A junior bacon cheeseburger, junior fries, 4-piece nuggets, and a small drink. If you've been inside a Wendy's in the last 2 years, you've seen this deal. It's been central to Wendy's traffic recovery strategy. But let's look at what a $5 meal actually does to the economics of a restaurant. At the store level, that $5 bundle costs approximately $2.50 to $2.75 in raw food and packaging. That's a food cost ratio of 50 to 55%, significantly worse than the fast food industry's standard target of 30 to 35%. At normal menu prices, junior bacon cheeseburger alone might carry a food cost of 30%. Bundle it into a discounted package and the margin per item compresses fast. Because the goal of a value meal isn't to maximize profit on that specific transaction. It's to bring the customer through the door frequently enough that the overall relationship becomes profitable. A $5 deal attracts price-sensitive customers who might otherwise go to a grocery store, convenience store, or a competitor. It drives transaction volume, which keeps the kitchen operating efficiently and ensures perishable inventory like fresh beef moves before it expires. It creates an anchor price in the customer's mind, a reason to choose Wendy's over the alternatives, and it opens the door to add-on purchases of higher-margin items like specialty drinks and desserts. Think of the value meal as a loss leader for the full visit. But the psychological risk is real. When a brand consistently offers meals at $5, it trains customers to expect that price point as the baseline. Once that anchor is set, raising prices feels like a breach of the implicit contract. The same promotion that builds traffic in a slow quarter can undermine pricing power across the entire menu for years afterward. The same deal that brings customers through the door can also train customers to believe that Wendy's should always be cheap. Here's the problem Wendy's faces that it can't fully solve no matter how smart the strategy is. Costs go up. They always go up. Beef prices fluctuate with cattle markets and drought cycles. Labor costs rise with minimum wage legislation and worker competition. Commercial rents increase at renewal. Energy rates climb. Every one of these input costs is largely outside Wendy's direct control, and every one directly affects whether a franchise location can survive. When costs rise, the brand has three choices. Dotman 1. Raise menu prices. This protects the margin but risks losing customers who are making real-time comparisons against competitors. Fast food is one of the most substitutable categories in consumer spending. A customer who decides Wendy's is too expensive doesn't have to go home hungry. They can walk next door to McDonald's, or stop at a convenience store, or pull something out of the fridge. The switching cost is essentially 0 to absorb the cost increase. This protects customer traffic but sacrifices profitability for both the franchisee and, eventually, for corporate's royalty stream, since lower sales mean lower royalties. Option 3. Reduce portion sizes or reformulate the value offering. This protects the financial math but risks the one thing that's hardest to rebuild: customer trust in the product itself. None of these options is clean. Each one trades a short-term gain for a long-term exposure. And the difficulty compounds because Wendy's isn't making these decisions in isolation. It's negotiating them across a franchise system, where thousands of independent operators are simultaneously navigating the same cost pressures with their own capital constraints and their own breaking points. Wendy's is not competing only against other burgers. It is competing against the customer's entire food budget. In early 2024, Wendy's became the center of one of the stranger corporate controversies in recent fast food history. During an earnings call, the CEO discussed a $20 million investment in digital menu boards across the restaurant system. Technology that would enable AI-driven suggestive selling, daypart menu changes, and what the company called dynamic pricing capabilities. From a purely financial standpoint, the logic was sound. Dynamic pricing, adjusting prices based on demand patterns, is standard practice in airlines, hotels, ride-sharing, and streaming services. Charge more during peak demand, offer discounts during slow periods. The economics are straightforward. What Wendy's didn't account for was how that language would land with a public already frustrated by years of post-pandemic price increases across every spending category. The phrase dynamic pricing was immediately interpreted as surge pricing, the idea that a burger would cost more during the busy lunch rush. Social media amplified it into a narrative about a fast food chain charging more precisely when customers were most desperate for a quick meal. Calls for boycotts spread. The story landed in national media. Politicians commented. Wendy's quickly clarified that the digital boards were intended to support off-peak discounting and menu flexibility, not peak-hour price hikes. But the correction barely registered compared to the original story. The lesson here goes beyond Wendy's. A pricing strategy can be economically rational, but psychologically disastrous. Customers don't evaluate prices the way economists do. They evaluate them through the lens of fairness. And any mechanism that feels like it's designed to charge more based on urgency or time of need triggers an immediate and deeply personal reaction. The problem wasn't the price change. The problem was trust. And this is where Wendy's economics becomes more interesting. The biggest asset in the entire system may not be the restaurants. It may be the brand itself. Let's be precise about what a brand actually is, financially, because brand is one of those words that gets used constantly without ever being defined usefully. A strong brand is a cost reduction mechanism and a pricing power mechanism simultaneously. It reduces what you need to spend to acquire each new customer, because customers already know who you are. It increases what customers are willing to pay, because they believe the product is different from, or better than, the unbranded alternative. And it makes the advertising you spend far more effective, because every impression lands on a foundation of existing familiarity. For a franchise system, brand strength does one more critical thing. It attracts and retains high-quality franchisees. If your brand is strong, operators believe customers will walk through the door because of the name above it. If the brand weakens, franchisees start questioning whether the royalties and fees they're paying generate enough traffic to justify the cost. Wendy's has built its brand around a few specific differentiated ideas. The fresh, never-frozen beef positioning. The square hamburger patty, distinctive in a category dominated by round shapes. The legacy of founder Dave Thomas and his direct, no-nonsense personality. And more recently, a social media presence built on wit and irreverence that has given the brand a recognizable voice online. These aren't decorative features, they're economic assets. They're what allows Wendy's to charge more than a generic burger stand, and justify the premium to customers who have dozens of alternatives within a few minutes' drive. But brand equity is not permanent. It requires constant maintenance, and it can erode faster than it's built. If customers come to believe that the gap between what Wendy's charges and what the food's worth has grown too wide, if the brand promises fresh and premium, but the experience feels like standard fast food at premium prices, the perception shifts, and the economic value of the brand declines. That is why Wendy's current challenge is not simply selling more burgers. It is convincing customers that the burger is worth the price. Here's a concept that trips up almost everyone who looks at a fast food chain for the first time. High sales volume does not equal profitability. A restaurant can have a line out the door and still be losing money. The reason is the fixed cost structure of the business, the expenses that must be paid regardless of how many customers walk through the door. Consider a typical franchise location. Food and packaging costs run 30 to 35% of gross sales. Labor runs another 28 to 32%. Rent and occupancy take 6 to 8%. Royalties and advertising contributions claim another 8 to 10%. Utilities, repairs, and technology fees add 5 to 7%. Third-party delivery platform commissions, 20 to 30% on every delivery order, add more. Run through all of that, and a well-run location might generate a store-level EBITDA margin of 8 to 12%. That's the number that needs to cover debt service on the initial investment, the franchisee's return on capital, and future renovations. In 2025, that margin was under serious pressure. Average U.S. franchisee EBITDA margins fell by 270 basis points to approximately 9.3%. Over half of that decline was driven directly by commodity inflation, particularly beef. The franchisee can't control cattle markets. They can't easily reduce labor below minimum compliance levels. Their rent is locked into a multi-year lease. What they can control is limited, and when multiple cost lines move against them simultaneously, the math breaks down quickly. This is also why restaurant closures are not always signs of corporate failure. Closing an underperforming location can actually improve the economics of the remaining system. A store that generates insufficient sales to cover its fixed costs is destroying value every day it stays open. Removing it reduces losses for the franchisee, protects nearby locations from cannibalization, and removes a physical point of contact where customers might be having a disappointing brand experience. The goal is not maximum store count. The goal is maximum productive store count. Here is the structural blind spot in the franchise model that almost no one talks about until it becomes a crisis. Wendy's corporate revenues are tied to gross system-wide sales, the top line of every franchise restaurant before any costs, not net profitability, not franchisee margins, just the total volume of food sold across the system. This means that when franchisee margins are shrinking, when operators are being squeezed by commodity costs, labor inflation, and declining traffic, the corporate revenue statement can still look relatively healthy. Royalties keep flowing. Advertising contributions keep arriving. The franchise fees from renewals and transfers keep landing. The corporate financials look resilient right up until the moment the system's underlying health has deteriorated to the point where operators can no longer sustain it. In 2025, this dynamic was visible in Wendy's numbers. Despite U.S. same-store sales falling 6% for the full year and 11.3% in the fourth quarter alone, Wendy still generated adjusted EBITDA of $522 million and free cash flow of $205 million. The franchise model was doing exactly what it was designed to do, insulating corporate from the immediate impact of store-level pain, but the lagged consequences are real. When franchisee margins compress, operators stop funding new restaurant development. They slow renovations, they exit marginal locations. The development pipeline, the engine that generates future royalty growth, stalls. What looks like financial resilience at the corporate level today can be the early signal of a contracting system in 3 to 5 years. This is the paradox of franchising. The company can scale by pushing investment onto franchisees. But if the economics become unattractive for franchisees, the same system can suddenly stop growing. The most important challenge Wendy's faces right now is not a supply chain issue or a menu problem or a real estate issue. It's a psychological one. Fast food prices rose significantly between 2021 and 2024. Wendy's, like every major quick service brand, passed on a portion of its input cost increases to the menu. A meal that cost $8 or $9 in 2019 might cost $12 to $15 by 2024. Consumers noticed. The result is a growing gap between what fast food actually costs and what consumers feel it should cost. When that gap widens, customers recalibrate. They trade down to convenience stores. They cook more at home. They visit less frequently. They respond only to discounts, which means the brand must spend more on promotions just to hold the same traffic, compressing margins further. Wendy's is caught between two identities that are difficult to hold simultaneously. On one side, a premium fast food brand. Fresh, never frozen beef. Square patties that signal quality. A brand that charges a bit more because it delivers something a bit better than the standard fast food experience. On the other side, an accessible quick service brand. $5 value meals. Biggie bag promotions. a brand that competes directly with McDonald's and Burger King for price-conscious customers who are making decisions at the register based on the lowest visible price. These identities pull in opposite directions. Aggressive discounting protects short-term traffic, but erodes the premium positioning that justifies higher prices on the rest of the menu. Protecting premium pricing protects margins, but accelerates the loss of the value-conscious customers who make up the bulk of fast food traffic. There is no clean answer to this tension. Every pricing decision is a negotiation between two versions of what Wendy's is supposed to be. While the domestic U.S. story for Wendy's in 2025 was largely defined by declining same-store sales and franchisee margin pressure, the international picture told a meaningfully different story. International same-store sales grew 1.3% in fiscal 2025, even as U.S. comparable sales fell 5.6%. Total international system-wide sales increased by 8.1%. The international unit count grew from 1,307 restaurants in 2024 to 1,428 in 2025, a net addition of 121 units, a 24.7% improvement in net openings year over year. The reason international markets can outperform domestic ones comes down to structural differences in the economics. In markets where Wendy's is still establishing itself, competition may be less saturated. Real estate costs in certain markets can be more favorable. The brand carries a degree of novelty that sustains higher customer interest and better opening week traffic. Wendy's expansion in Australia is a useful example. Through a partnership with Flynn Group, one of the largest multi-brand franchise operators in the world, Wendy's opened its first Australian location in Surfers Paradise in early 2025 and a second in Brisbane later that year. Both reportedly set all-time opening sales records for the brand internationally. Part of that success came from menu localization. Australian locations feature hand-breaded chicken tenders made with locally sourced poultry, combining the core Wendy's identity with products built for local preferences and supply chains. The economic principle here is important. The same brand can have fundamentally different unit economics in different markets. A royalty-based business model benefits disproportionately from international expansion. Each new restaurant adds to the system-wide sales base that generates royalties, with relatively low incremental corporate cost. If international markets continue to grow while the domestic system stabilizes, the geographic mix of Wendy's revenue base shifts toward markets where the growth trajectory is still early and the competitive intensity is lower. Here's where the entire system comes together and where the real complexity of running a franchise business becomes visible. The question isn't simply whether Wendy's can sell more burgers. It's whether the company can simultaneously restore franchisee profitability, rebuild customer trust in the brand's value proposition, restart the development pipeline, and deliver investor returns, all at the same time with the same levers. In response to 2025's deteriorating domestic performance, Wendy's launched a turnaround strategy called Project Fresh. The plan has several components. On the footprint side, Wendy's plans to close 5 to 6% of underperforming U.S. locations in the first half of 2026. These are the margin-dilutive stores, the ones in weak trade areas, the ones with franchise partners who can't generate sufficient traffic to cover costs. Removing them from the system reduces the drag on system-wide averages and allows capital and management attention to concentrate on higher-performing units. On the capital side, Wendy's is pulling back from its U.S. Build-to-Suit development program, a corporate-funded initiative that financed new restaurant construction for franchisees. The company cut that funding by $20 million in 2025, with larger reductions planned for 2026. Those resources are being redirected toward technology and marketing effectiveness, investments that generate leverage across the whole system rather than capital tied up in specific locations. On the menu side, Wendy's is refining its value architecture. The Biggie platform provides a tiered entry point for price-sensitive customers. Premium burger and chicken sandwich options are being developed and positioned to attract a broader spending range. The goal is to rebuild the latter. Give customers a reason to start with a $5 value meal and a reason to trade up to something more profitable. The 2026 financial guidance tells the honest story. Adjusted EBITDA is expected to fall to somewhere between $460 and $480 million, down from $522 million in 2025. Free cash flow guidance is $190 to $205 million. The system is absorbing the cost of restructuring before the benefits of that restructuring show up in the numbers. Whether it works depends on something no financial model can fully capture. Whether customers decide the burger is worth the price. Whether franchisees decide the opportunity is worth the capital. Whether the brand maintains enough distinctiveness to justify its existence in an increasingly crowded, increasingly price-pressured market. Wendy's is not simply in the business of selling food. It is managing an economic ecosystem where the customer wants value, the franchisee needs profit, corporate wants royalties, and investors expect returns. Every pricing decision, every promotional campaign, every store closure, every international development deal is a negotiation between those competing interests. Get it right, and the franchise machine keeps compounding. Get it wrong, and the whole structure decays from the bottom up, slowly at first and then all at once. The future of Wendy's may not depend on whether people still like its burgers. It may depend on whether everyone in the Wendy's economic system still believes those burgers are worth the price.